3 months into the 2K to 1 mil challenge, we have hit a major reality check. After an incredible start where we more than doubled the account, this month has been one of the toughest trading period I have experienced in a long time. In fact, ever since returning from my overseas trip, I haven't had a single winning trade. And strangely enough, I'm actually grateful for that. Sometimes, the market teaches us lessons that backtesting never can. When everything is going well, you easily believe you have figured it all out. But when you go through a painful losing streak, you are forced to slow down, reflect, and identify what's really missing from the strategy. That's exactly what happened to me this month. I realized that while my strategy was profitable in the early stages of the challenge, there were still important pieces of the puzzle that I had not fully understood. The market exposed those weaknesses, and that's a gift. Looking back, the rapid gains in month 1 and month 2 were not purely skill. Luck played a larger role than I initially appreciated. Many of the trades worked because market conditions happened to align with my setups. One of the key factors was the relationship between the currency pair that I'm trading and the DXY. At that time, I wasn't giving enough attention to the DXY, yet many of my winning trades worked because DXY was coincidentally reversing in a way that supported my position. In other words, the trades were valid, but I didn't understand fully why they were working. That distinction is crucial. This month, I make it clear that I need stronger alignment between the setup of the pair I'm trading, the directional bias of the XY, the timing of both the instrument's inflection zone. So if DXY and the pair are not moving in sync, the probability of success drops significantly. This insight has become an essential part of refining my edge. So let me go through the POW example to illustrate what I meant by this. So on 9 April, around 11:55 Singapore timing, I enter a POW short trade. Because if you look at this setup, it looks totally fine. Look at the day structure, day chart. We have hit an inflection zone over here. And it's based on my strategy, and it is actually a good entry zone to enter a short with SL slightly above the resistance zone with target to the next day support area. Everything seems okay. However, it's not. Let me tell you why. Because we totally neglected the need to actually verify back to the DXY to see whether both are telling me that this direction bias is correct. Whether there's confluence from DXY telling me that we should short POW. Meaning to say, if DXY is heading upwards, means POW USD, there's a short opportunity because bullish DXY means bearish POW USD. So same, we look back into 9 April, 11:55 setup for DXY, you'll notice that we are in no man's land, right? Ignore this first. 9 April to 6, we look back. The day structure, we are not in any support or resistance zone. We are actually in the midst of the no touch zone from the support or resistance. Meaning to say, there are no confluence of where POW will be going. Sure enough, you have yet to reach a support zone, and therefore, when we would have this idea of shorting POW at the resistance zone, let's see what happened. It seems like going your way a while, but before you know it, it went all the way up to spike the SL. Because in the DXY chart, we are nowhere near this zone, right? We are nowhere near the support zone. So both have to go hand in hand. So let me give you another example of a successful setup. This successful setup I'm talking about is where DXY and EURUSD goes hand in hand, telling us that the setup is ready. So Looking at EURUSD, this is a setup I took on 22nd May, 10 p.m. Singapore timing. So what happened is, similarly, based on the day structure, we know that we are in a support zone. So we go down deeper in a shorter time frame to see whether there are patterns set up for us to have a shorter SL zone to have an amplified TP zone, so that risk reward is more favorable for us. So if you look at this, we actually enter exactly at where it reversed, which is at 22nd May, 10 p.m. Why? Because I look deeper in the DXY as well and look at patterns, and they are all telling me that inflection zones are in place. So you look at DXY, it's exactly at the same inflection zone, meaning to say a point whereby there will have some signs that the price action will reverse. Looking at the day chart for DXY as well, we are right smack in a day structure resistance zone, which confluence with EURUSD support zone. So if both are in line, the trade that I take will have a higher probability of success. And that's how I capture at least 4.86R for this trade. So one of the biggest lessons in trading is that no matter how much progress you have made, there's always another layer of refinement. The goal is not to find a perfect strategy overnight. The goal is to continuously improve your blueprint until it becomes robust enough to generate consistent six-figure returns over time. Until then, every small success should be viewed with humility. Winning a few trades or even doubling an account doesn't mean the system is complete. So as of today, the account has retraced all the gains and is essentially near to break-even point. We are right back where we started, and honestly, I'm thankful this happened now. I would much rather discover these weaknesses in month 3 than later in the challenge when the account size is much larger and the emotional impact is far greater. So backtesting and forward testing are essential. There's no substitute for real capital on the line. The emotional pain of actual losses forces you to dig deeper than any spreadsheet ever will. That pain reveals flaws, challenges assumptions, and sharpens your edge. This month was humbling, but it also provided some of the most valuable lessons of the entire journey so far. We may be back to break even financially, but intellectually, we are miles ahead. The blueprint is becoming clearer, the edge is becoming stronger, and the journey continues. See you in month 4.